Good morning, everyone. Thank you so much for joining us at our next Getting to Contracts workshops powered by APS. We are so glad that you are here. Today's session will focus on business finance, more specifically bankability, cash flow, and sources of funding. Today we have two wonderful speakers and our very own MBDA business consultants, Yvette Uriondo and John Mascarenas, who will be presenting today's presentation. Just a couple housekeeping rules here. We have the chat and Q&A, so in case you have any questions for either of them, please put them there. We do have some time at the end for Q&A as well, so if you'd like to stick around, we'll have some reserved time for that. Also, we want to thank APS again for helping us put this program together. This is a series of 8 workshops. So I'll have Sylvia just kind of touch base a little bit more about our partnership and why we're bringing these programs to you all. So with that, I'd like to hand it off to Sylvia for now. And then after that, I welcome Yvette to kick us off for our workshop this morning. So thank you so much, Sylvia, Yvette, and John, and I'll let you all take it from here.
Awesome. Thank you so much. And also thank you everyone for having me this morning. Again, my name is Sylvia Manzanares. I'm the Supplier Diversity Program Manager at APS. So pretty much the essence of what I do every day is to connect local and diverse suppliers to do business with APS. And one of the things that also APS helps is to strengthen those suppliers. So we've, in the past worked with the Hispanic Chamber and other, in the communities to help local suppliers. So I think today's topic is really on point and very important to us because we want strong and healthy suppliers to do business with us. Because if you are in the business and if you're, long-term providing products and services that APS needs, then we want to do business with you. So, APS wants to partner to create this type of format so that, we can partner and we can work together. And one of the things that I do in my role is to partner with the chambers, with local certification agencies, to look for suppliers like you, to do business with us. And one of the things in today's topic, cash flow, I think it's a great topic, at least in my role and in my past life, as I was actually a buyer for APS. So we work with local companies to make sure that they were healthy. And I wanted to just give one tip is different companies have pay terms, and I'm sure they'll probably go over this. And a lot of big companies have pretty long pay terms like net 45. So, and that could be tough for companies, but those are negotiable. And a lot of companies have discounts. APS provides the discounts and they'll pay within 15 days if you do like a 1%, 2%, 3% discount. So just know that you have options, and I'm here to help you to do business with APS. In the chat, I'm going to put a link to register with APS as a supplier. Thank you so much, and I'm looking forward to today's session. And I'll turn it over to Yvette.
Thank you, Sylvia, and thank you very much for that information. So I'm going to go ahead and start sharing my screen. Can you all see that?
Yes, thank you, Yvette.
Okay, wonderful. So thanks again, Sylvia, and welcome, and thank you all for joining us this morning. My name is Yvette Uriondo. My colleague, John Mascarenas, and I will be presenting the business finance segment on bankability, cash flow, and sources of funding. We are senior business consultants at the Phoenix MBDA Business Center. And I ask that you please be prepared to take plenty of notes and save your questions till the end because we do have a lot of information to share with you. The center is locally operated by the Arizona Hispanic Chamber of Commerce and federally funded by the Minority Business Development Agency, U.S. Department of Commerce, and is the only federal agency solely dedicated to the growth and global competitiveness of minority business enterprises. There are 34 centers throughout the United States, and the Phoenix MBDA Business Center has been proudly serving the minority business community since 1997. We provide specialized consulting to small minority-owned businesses and help with business development, capacity building, building scale, expanding your business base, and much, much more. This introductory presentation, we will share what a small business owner can do to improve bankability, share a brief overview on cash flow, and John Mascareñas will present sources of funding, which will offer insight to what capital sources are available to small businesses. The three introductory topics are initial steps that help small minority-owned businesses understand the importance of developing a business financial plan. These, as you see here, are the topics for today, and we won't be getting into the weeds due to time. So we're going to go through each topic you see below in the next following slides. And as I said before, please do take notes because we have a lot of information to share and didn't want to pack it in into so many slides. So I looked up the word bankability, and there are three words that stand out in the definition of bankability: stable, profitability, and successful. The stability of a company makes it profitable and successful. So we're going to go through what makes a business loan worthy. So number one is credit rating. So a solid credit rating lends legitimacy to your request for a loan and shows you're less of a financial risk to a bank. They'll want to see that you have a history of paying bills on time. So doing that is a great place to start. If you apply for an SBA loan, that bank might utilize the FICO Small Business Scoring Service, SBSS, to access your credit risk. If you can't meet the minimum scores, which vary amongst lenders, you'll need to step back and take time to improve your credit score and your credit presence. Business and personal credit scores are similar in concept. Both are designed to show creditworthiness and evaluate potential risks for lenders or other financial partners. And both business and personal credit scores take into account various factors like the ability to repay debt and make timely payments. Banks also check for recent bankruptcies and evidence of cash flow. These are not, if these are not in good standing, they are immediate deal breakers. Number two, a business must be in a solid industry. Industries such as food, services, beauty salons, cannabis shops, and apparel, just to name a few, are among the 12 industries considered extremely risky to potential lenders. Item 3, demonstrate your experience and offer real measurable examples of expertise in your chosen industry or of your track record in running a successful business. Banks back people, not an idea. So you'll have to convince them you have the skill set that will make their lending decision a success. Number 4, illustrate repayment from revenue and demonstrate an ability to repay expenses from revenues, not collateral. Lenders and investors prefer to see that you have a revenue stream to repay the loan. They don't necessarily want collateral or to own your home. The most conservative lenders or investors ask for 2 years of positive cash flow, and we'll go through cash flow in just a bit. Item number 5, lenders and investors want to see that you have personal investment or cash. What's your skin in the game before helping you? If you have nothing at risk, your level of commitment is kind of suspect to them. As a general rule, your investment should be at least 20% of the total projected loan requirement. That amount may vary amongst lenders. Number 6, bankers as well as investors will not lend you money so that you can pay yourself. The SBA loan, like the Paycheck Protection Program and the Economic Injury Disaster Loan, EIDL, were specifically developed for the COVID-19 pandemic only. That's where you would put your pay information, but do not include it when you're applying. Number 7 is a business plan necessary? A business plan helps you identify those places where you need additional work and easily converts to your operation management plan and your standard operating procedures. A business plan isn't just a mechanism that gauges your success, although it is definitely that. It describes who your customers are, how they pay you, how you're different from others, and your experience level. It also helps you understand your capacity to repay a loan. A business plan should also show 2 to 3 years of financial projections, like month-to-month revenue and detailed expenses. Basically, it ultimately shows how you're going to be able to repay a loan and your personal investment, cash. A business with 2 years positive tax history or more doesn't necessarily need a business plan, but it's never a bad thing to have one on hand. Not all lenders will ask you for a business plan, but investors definitely will. So we're going to just take a quick look at what loans may be approved and what might be declined. So on the left, you'll see that this particular fictitious business, they had a business plan, they have a solid business industry, they've got great credit, strong financials and financial tools. They have a positive history of, on their tax returns. They repay their expenses from revenue. They don't use collateral, they have 20% of the loan investment available in their bank. They have built an excellent relationship with the lender, and they don't have a criminal record, which is something that banks look at. And then on the left, the most likely to be declined would be a company that has less than 2 years in the business. They probably don't have a business plan. Some don't even know what a business plan is. They are in a risky business industry or market. Their credit score is low. They have no financial reporting tools. They don't, they probably don't even have a bookkeeper or an accountant. Their tax returns show negative history. They haven't filed taxes, or maybe their back taxes owed. They don't have enough revenue to pay expenses, so they use collateral. They have no skin in the game. They don't have that 20% available. They don't have a relationship with a lender. They may have a criminal record. They may have recently filed for bankruptcy. And if they owe child support, if their child support is delinquent, that too can be an issue. So we're going to take a quick look now at the pros and cons of a line of credit. So one of the best aspects of negotiating a line of credit is the relationship you build with the lender. Over time, the lending representative will advise when the best rates are available because she or he understands your financial needs. Should you need funds or for a project or a small purchase. You want to select the right source of funding for your business. Some small business owners may turn to personal cash or seek investors, or maybe they'll obtain a business line of credit, for a source of funding. Each has its own set of advantages and disadvantages. However, before you obtain a business line of credit, understand the pros and cons first, and make sure it's the right source of funding for your small business needs. Then item number 2, or bullet point number 2, a line of credit provides some flexibility to your small business because a line of credit allows you to access money when you need it rather than having to take it in a lump sum like a business loan. It provides the cash you need without costing you more in interest. Its flexibility makes a business line of credit a useful tool for managing cash flow of a business. Use the line of credit when you need to pay something off, something that you can pay off quickly, but please, please, please pay it off right away once the funds are available. And then the cons, a line of credit can result in a mountain of fees for maintenance and withdrawals. Make sure that your interest rate is low enough to justify any added fees, but also do your homework before opening a line of credit. Contact your business consultant or your finance professional. As far as business obligation, a line of credit can also put your business at risk. Even if your business fails, a line of credit is a business obligation that has to be repaid. Whether you're personally liable to repay the debt depends on the structure of the business. For example, a sole proprietor may be liable when a corporation can relieve you from any personal obligation. Then there are application difficulties that come up. When you apply for a line of credit, your application may require that your business be at least 2 years old. You may be asked to provide extensive financial reports, including tax returns, cash flow statements, and more. Then there's that temptation. While a line of credit is nice to have on hand for an emergency, you could ultimately find that you've spent the entire amount you have access to, and now you're unable to repay it because of, let's say, a business slowdown. In some cases, businesses may be better off with a standard loan to avoid that temptation of access to immediate cash. Again, always consult your financial professional or your business consultant. Richard Bronson has written several books. He's a multimillionaire in the UK. I have always found his books of interest, and I have always felt that lifeblood is cash is not just the lifeblood; it's the vitality of your business as well. Cash flow is the amount of money going into and out of your business. A healthy cash flow can help lead your business on the path of success. But poor or negative cash flow can spell doom for the future of your business. So you want to stay clear of any cash flow problems. It's crucial that you never ever shy away from the financial management of a business. You want to learn every aspect of your business cash flow. Otherwise, it will cause a business failure. Appreciate how important cash flow is. Use the right resources you can so you can do this simply without a degree in accounting. Then you want to understand the basics of cash flow in management and accounting so that it's easier for you to keep tabs on your firm's financial health. You want to have a system in place that ensures that you and other key financial personnel can monitor your cash flow regularly. Then value it. Research shows that poor cash flow is the reason behind about 80% of small business failures. 2/3 of small businesses survive 2 years. Only 44% make it through 4 years, and just 31% last 7 years. With sufficient cash flow, you can greatly increase the odds of your business surviving and thriving. The first step is to recognize and appreciate the essential positive cash flow in your business. It's one of the most important things you can do as a small business owner. Then you want to understand it. Learn the basics of monitoring cash flow. Learn what the most important, what's the most important measurements are, and apply those to your business financial health. Even if you have a designated expert, on staff, it's always a good thing to have. Then delegation is important and necessary, but the buck ultimately stops with you. Being able to understand your financial concepts and the language of accounting better enables you to evaluate the financial health of your business. Then monitor your cash flow, because armed with good intentions and basic knowledge, you can monitor your cash flow. Look at the current financial situation, but also pay attention to patterns like how long certain clients take to pay their bills. If problems come up, it's extremely important for you to pinpoint the causes early so that you can act on them effectively. A general rule banks lend on is cash flow and the 5 C's. This is going to be a little bit long because they do take some explanation, but I've highlighted specific words for you. So character, when lenders evaluate character, they look at stability. Character isn't a question of your personal charm or your beauty or your charisma. It's your business character that the bank will assess. They look at your experience in business in general and in the industry in which your business will operate. If you want a loan for your business, the lender may consider your experience and track record in your business and industry to evaluate how trustworthy you are to repay. Capacity refers to cash, debts, and expenses when determining your ability to repay the loan. Creditors evaluate your debt to income ratio, that is how much you owe compared to how much you earn. Capacity or cash flow represents your ability to generate income that will pay your debts. If you're starting a new business, the bank assesses your global cash flow, which is your current personal income as well as your projected income from the business. The bank won't give you money if it sees no evidence that you can repay it. Your capacity is an important part of the evaluation process for the loan. If you don't have sufficient capacity, you can consider bringing in a partner to add cash flow to your scenario. Capital refers to your net worth, the value of your assets minus your liabilities. It's also referred to in the industry as equity injection. Capital is your skin in the game in the lending transaction. No bank will fund your business at 100% if your total of your total cash needs. If you have a small business, typically the bank will require you to contribute 20% of the loan amount. Some may require less. Capital is a deal breaker for banks. Most advisors will tell you not to proceed with preparing a loan application if you can't provide the required contribution. If you don't have the capital, your goal becomes figuring out how to raise it. Then collateral. A collateral refers to assets, and it's a lengthy topic, lengthier than I've been, yapping about. And we could discuss it. We can discuss secured and unsecured loans, risk, and much more, but time is limited. Small business owners may not realize that even if they create an LLC, the business owner has to guarantee any loan to get funding. Most banks and credit unions require any 20% or greater owner to be a personal guarantor of a loan. That means that if the business isn't able to make the loan payments, the individuals are personally, and I repeat, personally responsible. In addition, collateral refers to any assets belonging to a borrower that a lender has the right to take ownership of and use it if to pay the debt if the borrower is unable to make the loan payments as agreed. Then you have conditions, and it refers to the business's financial health. Lenders consider a number of outside circumstances that may affect the borrower's financial situation and ability to repay. The lender may evaluate financial health of the borrower's industry, their local market, and competition. These are not the only consideration the bank will use, but they are the most common. Conditions also refer to responding, explaining, and resolving conditions the lender questions prior to approving a loan. If these conditions are not explained and unsatisfactory, a loan will not be approved. Now we're going to move on to cash flow projections, and I know that there's a lot of information on this tiny little slide, but please bear with me. On the cash flow projection, as the year starts to unfold, you begin to understand your cash flow and learn about cash flow projections. Simply put, a cash flow projection estimates the money you expect to flow in and out of your business, including all of your income and expenses. It's part of your budgeting process. Typically, most businesses cash flow projections cover 12-month period, as you see here on this particular slide, and sometimes more. Your business can create a weekly, monthly, or semi-annual cash flow projection. But you'll hear me say this time and time again, monitor your cash flow periodically. Even the most successful organizations find that their forecast changes regularly. So it's important to monitor your cash flow. There are several tools and software applications designed specifically to help you track your cash flow. Another option is to work closely with an accountant and your bookkeeper. Projecting cash flow has many advantages, and it includes being able to predict cash flow shortages and surpluses. You can see and compare business expenses and income for specific periods. You can monitor the effects of the business change, like hiring employees or price changes. It shows a lender your ability to repay on time and determine if you need to make adjustments, such as cutting expenses. A cash flow projection is an excellent tool to help manage your cash flow. Anticipated cash flow projections can help boost your business success. Please note that your projected cash flow analysis can be time consuming and very, very costly if it's not done correctly. Then the cash flow statement that you see below are indicative of your business's health. It shows that at any given time, your company is a healthy business, capable of continuing to operate. Sorry about that. There are lots of extensive backgrounds on cash flow statements. There are some basic terms and elements of a cash flow statement you may need to create or customize by yourself or with your internal employees. The statements measure how well the company generates cash to pay its debt obligations and operating expenses. It also complements the balance sheet and income statement, and it's been a mandatory part of company financial reports since 1987. Other financial documents are your profit and loss statements, your receivables aging report, your personal financial statements. They are sometimes part of the financial report as well. There are some basic videos that provide concrete examples of cash flow statements and how to read them. Then, if you have an accurate idea of your company's cash flow, these are, quick and simple tips to help you increase some cash flow. So monitor your cash flow. Again, monitor your cash flow. The most important aspects of managing cash flow is to constantly be monitoring it. You need to know how much money your company is taking in, and you need to know how much cash you have on hand. Then cut cost. Do your best to tighten up where you can. If your company is losing money, this is a great first step to getting business back on its feet. If you're in a real pinch, negotiate to delay a payment. Do your best to maintain a healthy relationship with all vendors and avoid late fees or disgruntled vendors. Depending on who you're working with, you may be able to put some payments off and make sure that you pay them off as soon as funds are available in that account. Then invoice financing, that's also known as invoice factoring. It may be another way to get advance payments on outstanding invoices. It can help your company get the money it deserves earlier than a client is willing to pay. However, I must stress, fees do apply. Factoring will reduce your business income by 1 to 3% and sometimes more per invoice. Please be extremely cautious when you're using invoice factoring. I don't recommend this, but there are many small businesses that use this for quick cash. Then consider loan options. Sometimes all a company needs is a quick cash injection. Check into different sources of funding that are available, like a business loan, line of credit, or other financial options for your business. And remember, you should only be taking on debt if it's advantageous for your company. So that being said, the next segment of our presentation is sources of funding, which is coming right up with John Mascareñas. John?
Yes, thank you. Thank you, Yvette. Good morning, everybody. Hold on, let me get my screen up here. Can everybody see that? You guys see that?
Yes.
Yes.
Okay, thank you. Hey, good morning, everybody. So thank you, Yvette. A good presentation, a good lead into what I'm going to be talking about here. So sources of funding. This is really a primer for everybody on the line here. This is a primer for any small business who is seeking capital through funding. And I'll walk us through that. And any questions, please hold them up to the end. So it's important to understand as we go forward here what capital really is. In business, the word capital can have, well, the word capital in general can have different meanings depending on the context, but in business and in a broader sense, capital is anything that confers any kind of value or benefit to its owner. You as a CEO, owner of a business can have factory, machinery, buildings, intellectual property, or financial assets of a business, or even of an individual, including cash. So for the purpose of this conversation, the context of capital here is operating cash, and under the financial category of capital assets. So capital is cash from this perspective. I guess yeah, there's two main things that a CEO or founder of a company needs to keep in mind. And in the early stages of any company, it's important that the CEO, the founder, keep two things in mind. One, their main job is to make sure they have a strong team underneath them, behind them, with them. And secondly, and not in any order of priority here, the CEO's main responsibility in this case is to make sure that the company never runs out of cash or capital in this case. And how do you get capital into your business? Yeah, you go through a funding process. A business funding is the act or the process of providing operating cash so that the company can continue to run as an entity, as an organization, or to expand. That's critical. There are multiple ways and resources to fund your business. I mean, there's, what we're going to talk about today is only a sample of what could be out there, depending how creative you want to get, how risky do you want to, how much risk you want to put on the money that you're acquiring, et cetera. And each method of funding will bring its own set of criteria, requirements, risks, and outcomes to the company. So funding a small business, there's two really basic ways to fund a business. You either take on debt on the right-hand side there of the chart, and debt is a lot of the stuff that Eva was talking about earlier, in the form of a loan, a letter of credit, what have you. But those are all things that have to be repaid. On your financial statements, these are carried as debt. And each debt on the loan provides some fixed income interest back to the lender. The other side of the coin, or on the other side of the chart here, is the other type of investment is equity investment. Equity investment, is what you see when you look at you've seen the Shark Tank. But what they're doing there is those investors are looking for an equity investment, and for that they are willing to give up a piece of the pie or a percentage of their company. So this equity investment really is you're giving up ownership of your company to some extent, depending on how much money you raise. So the investors, these are called investors, not lenders. The investors get paid back two ways. One, they have quarterly dividends, maybe annual dividends, depending on the terms of the investment agreement. And those dividends get paid back to the investors. Okay. In some cases, they don't get any dividends back, depending on how successful the operation has been or is. And the other way that they get their money back is at the end of a certain period of time, the investors can choose to sell their investment to someone else, or the company itself gets acquired by a larger organization or another company, and that's called a liquidation, where they get acquired, and they get acquired for multiples of cash. So it could be big money for the investors and the owners too. So, but it's a very high risk proposition. So you have two methodologies here for funding a business: debt, carried on the books; equity investment, you give up a part of your company. And those two become choices, depending on how you want your company to scale and how quickly you want it to scale. So types of funding, this is not all inclusive, but it's probably the major types of funding that are out there. Bootstrapping, as it's called, is when you fund yourself. There are no outside lenders, no outside investors. You're using your own cash. It is not debt, but it's your money. The problem with bootstrapping, as viewed by investors and or lenders, is that, hey, that's okay. This person is funding their company. Great, they can do it. They have the capital to do that. However, most of bootstrap companies end up falling into a category that most lenders or investors will look at as a lifestyle company, meaning that you are not willing to scale your company. You're okay putting your own money to work, but you're going to scale at a much slower pace, or maybe not ever. You'll grow maybe single-digit growth, and that's fine. I mean, that's a choice you need to make. You're providing income to your team, salaries, and you're just going on day to day. The problem with that is it's not a very attractive business to lend money to, nor is it a very attractive business for investors to put their money in. But again, your choice, your money, it's not debt. Then there's traditional loans, typically banks, and depending on the criteria, of your credit or the terms that the banks have on you as an individual, or on you as a business credit, they're going to apply their own terms. It's their money, it's their terms, but it's carried as debt. So that's another checkoff item you need to consider. And there's also alternative funding, not banks. These are companies who provide money. Some of them are typically to the internet loan providers. They usually offer a portfolio of different types of funding in the form of term loans, lines of credit, or as Yvette mentioned earlier, invoice factoring. They can be flexible. Others are less flexible, but it's based a lot on the business potential and the size of the funding that you're getting. But this also is carried as debt. Okay. I would consider alternative funding as a shorter term scenario for getting an infusion of cash that you need to meet an obligation and or scale the company quickly. I would not consider this to be long-term investment or financing opportunity here. And then there's grants. That's money that's provided usually by a government entity or even the private sector through some endowments, and usually do not need to be repaid. They do require some fund accountability for use of proceeds. It's usually smaller funding. It's not carried as debt. And this is one option that you can use given today's environment that we're in, for you to have some short-term cash infusion that is not carried as debt, but it's not a lot of money, but it might help, make ends meet initially. And there's bond financing, which is basically an IOU between a lender and your business. There's a maturity date, it comes with terms, and it usually carried as debt as well. Then there's other lending paths you can take. An SBA loan, you can apply for one. SBA, through its lending partners, such as community development organizations and or micro lending institutions, they can provide access to funds through the SBA that guarantees the funds. But you also must meet eligibility, and it's also carried as a debt, as a debt vehicle on your business. Then we get into private investors, which is a slightly different ball of wax here. Private investors are in it only for the return. You've seen Shark Tank, okay? It's based on returns. These are venture capitalists. They're also called angel investors, which are high net worth individuals who can put money to work. It's not free money. You end up giving some ownership of your company, so be prepared for that, that you are okay with doing that. They're in it for the high return of investment. They're not there to make you feel good. They're there to make you successful because they want the money plus back, okay? You can get bigger investments out of them, but you will have someone in your back pocket that is asking for accountability. They will they will own part of your company. They will ask for, things like quarterly financial statements. So once you get into that arena, yeah, you're talking big bucks, but you're talking a whole different ball of wax in terms of, accountability. Then last but not least, you have F&F, which is friends and family. And this is basically borrowing money from your friends or your families. There's pros and cons to this. I think the biggest risk here is a relationship risk, with your friends, your families, if the business fails, or you'll have, friends and families, and we all have friends and families, and some of them can be really pokey, nosy into your business. You may not like that. That's another business call that you need to make. It's a good segue into the next chart here, which I put together a funding risk quadrant here. And as I said earlier, each of these options carries its own criteria and risks. Bootstrapping, easier to start with, but harder long-term because you run out of cash if it's out of your own pocket. And if you have friends and families, I make that the harder one because you're talking about, it's an emotional thing now. You have grants, SBA loans, and as you go up the quadrant, you end up in the upper right quadrant, which is more risk. And you have more risk, but potentially higher reward. You have private investors, more cash. If you get acquired by a large company, you tend to make more money. And that's how companies like Microsoft, Intel, Google, you name them, they all started, way at the bottom left quadrant, bootstrapping themselves initially. And many of them jump right into private investment to get to where they're at today. But that's a risk that you have to weigh against how you want to scale your company and what your business plan is dictating where you want to go. Again, business plan, extremely important, okay, that you have a very comprehensive, easy to understand business plan. So preparing for external funding, I'm not talking about bootstrapping now. You decided to go out and get cash from an external entity. And I just mentioned having a good business plan. Well, a good business plan is incomplete without strong financial backing. Yvette mentioned cash flow is the lifeblood of a company, of a business. That is true. And without it flowing through the business, often than not, this business will not survive. So how do you prepare for external funding? One, become self and business credit worthy. And as Yvette mentioned, clean up any past negative items. Make sure you have a well thought out, realistic business plan. It's your vision. Put it down on paper, but make it clear. And doesn't have to be a 20-page business plan. I review literally hundreds, if not thousands of plans. And if you don't capture my attention in the first minute, I'm just going to put it aside. So a 10-page plan at the most is, and there's some outlines for that available online for that to happen. And through MBDA, we can help you get access to those templates. Third, have a concise, impactful capability statement, as we call them in the MBDA world, but they're also known out in the private sector as executive summaries. That's got to be clear and very concise and impactful. Present a history of your business, 2 years preferably. 2-year forward projections, 1 year past. Have a clear financial plan. And the next item here is know your numbers and know your business. I mean, Mr. Wonderful in Shark Tank, this is the kind of investors you're going to face out there. If you can't articulate your business, if you don't know your numbers, your financials, your projections, you're probably going to hit a solid wall. And of course, all of this can be a bit overwhelming if you're first starting out, even if you've been in business for a couple of years. If you need help, seek help. There are organizations like the MBDA who are here to help you do that, help you prepare for external funding. 3 simple steps to remember here. Make sure you have a service or product that's worth funding. Just because you have an idea doesn't make it, something that it's going to get either money lent to or funded. Understand why it's worth funding, believe in it, articulate it, and explain that clearly and concisely to anyone funding you. Those are the 3 things you have to remember going forward here. Summary. Multiple ways to fund your business. Each one has its own risk and criteria and success metrics. Understand the 3 main types: loans, equity, self-funded. Each one comes with either where there's debt, or you can have a debt, or you're going to give up part of the company. Be prepared, know your numbers, know your business. I mentioned that. Be concise, be clear. Have a clear capability statement. Develop a business and financial history that is clearly understood and you can back the data up. All those 3 simple steps that I just talked about earlier. Don't hesitate to ask for help. Use your contacts, use your resources. MBDA is here to help. And, other resources like the Hispanic Chamber of Commerce, etc. The next slide here, this is not all inclusive of samples of funding resources. This is just one idea of this. Again, you can go through this organizations and go through their process as well. MBDA can help you. The Hispanic Chamber of Commerce can help you. Other organizations are here to help you. Anyway, that's all I have. I know we're 6 minutes away from the top of the hour. I'll leave here a little bit for questions or Q&A. Thank you for your time.
Thank you so much, John and Yvette, for today's great presentation. I do see here a question that we received a little while ago. And it says, where and how can we see our business FICO score and ratings? So I believe this was a question for Yvette.
Yes, and so there again is where I say develop a relationship with your lender. Your business lender or your financial lender, your financial advisor at the bank can pull a business credit report and a personal. So please make sure that you stay in touch with them. You can also look online. There are so many places where you can get your business credit score. There are banks also that will offer that online. So please, but the most important thing is to develop that relationship with your lender or your financial institution.
Awesome, thank you so much. And we have, let me see in the chat, we don't have any questions here, but we do have a couple more minutes. While we wait for questions, maybe John or Yvette, any last minute thoughts or any other information that you would like to share with everyone?
Yeah, as I said before, always consult your financial professional or your business consultant before you start a loan application process or you're looking for a source of funding. It can save you time and frustration. Your financial professional can help you understand and, if necessary, improve your position. As business consultants, we guide you through packaging a loan and aligning you with the right lenders who want to help you to succeed and offer the best interest rates.
Great.
Yeah, just one last comment on my part. Everything Yvette said, plus if you choose to go the alternative way of not going down the debt way of getting a loan, going the way of private investment, either through an individual, an angel organization, or through a venture capitalist, is how you can quickly scale. That is probably the fastest way to scale, but you have to have your ducks in an order, all lined up really well in order for any investor to look at you. So, don't be afraid to take that first step. I had an opportunity one time to look at the Intel Corporation, $60 billion organization. They make the chips that run the world, really, because semiconductor. Their business plan was on 2 napkins. And that's what they went to investors with, a business plan on a napkin, and they later put it on a piece of paper. But I mean, don't be afraid. I mean, you'll be rejected probably 90% of the time, but you will once you get accepted, you're rocking and rolling. So, and don't be afraid to ask for help.
Thank you so much. So I don't see any other questions, so we'll go ahead and stop there. I appreciate both you, John, and Yvette for presenting today's presentation. Very dynamic and very useful information. So we'll share today's recording with everyone along with slides and Yvette and John's contact information as well in case you have any questions. You could always contact us at the chamber as well, and we could help connect you with the MBDA Business Center. With that, I'd like to conclude today's presentation. Our next workshop is in 2 more weeks. So we will regroup on May 4th at 10 a.m. More information to come, and we'll be sharing more information on the on-demand webinars that for the first and today's session as well. So thank you so much to both, and hope everyone has a great rest of your day. Bye-bye.
Thank you. Thank you all for attending.
Yes, thank you.